Dan is down at the cboe. Good to see you, Dan. Let's talk some Twitter,
Thanks,
all right?
Howard.
We were going to talk a little Apple here, but I'm with you, man. We've been talking Apple for weeks. Let's go into one of the beat-up names instead. You want to buy the dip here?
Well, I think that Twitter is setting up for potential for some, further upside. I know all the items you just discussed in the downgrade, but certainly Bank of America doesn't see it that way. They just recently upgraded the stock at a price target of 39. So, you are getting some disparity here on the risk-reward type of factor that Twitter finds itself in. And, they're rolling into the Q4 earnings. They're probably going to be the low point for earnings moving forward. They still have some issues they're trying to work out. But as you pointed out, there are some initiatives there that are changing the direction of Twitter, I think, moving forward, and I think it's going to put it in a much better position. And so when I look at Twitter here, coming off of the recent bottom, I think, from a trade example standpoint, it has an interesting setup. I think the way that I'd like to trade it, if I, from an example standpoint, is looking to buy a call spread to play for a push back to that 200-day moving average and close that gap that Michael talked about. But also, I like the opportunity here of selling a put to finance the purchase of that call spread, because if Twitter does fall back down to the $30 range, I don't mind picking it up there.
Yeah. All right. So you've got the call spread that you're buying, selling the March put. So the call spread, Dan, that you're owning, selling the put, seems like you're getting a lot of long leverage here. So where's your downside kind of buffer? Do you have one?
Yeah. The downside buffer is basically between where it's currently trading. I know it's off a little bit today. It's right around the 32.60 level. Your downside buffer is from 32.60 down to 30. Basically, from there, you just collect the small premium that you collect from putting this trade on. So basically, you buy the call spread, and then you sell that put, and that put basically finances the cost of the call spread. So you're not putting out any money to gain access to the stock by buying the call spread. Your risk is below 30. But again, that's a level where I don't mind getting long Twitter at that level. Say we're down there in March and we're at saying 29.5. I would pick up the stock just below 30 there, and again, I would own the stock, and that's a level I don't mind getting put into the stock. Same token, though, is if it does rip higher, I still have the opportunity to participate basically at no cost or no cash outlay from a call spread standpoint.